And there's kind of a big principle that came out of there, which was basically is whether or not at the time that you acquired the asset, the property, was your intention to make a profit. And then the second aspect of the Myer Emporium decision was, and whether the transaction involving that purchase were commercial transactions or done in a business-like manner or a business-like transaction. So it's kind of like two limbs of Myer Emporium for the principle of, yes, the amount's assessable as ordinary income, or yes, the amount's deductible as a revenue deduction. So that was the first issue that was debated in this case. The second issue was, well, you know, under Section 8.1, you've got to look at whether or not a loss or outgoing is incurred, and it's incurred in deriving assessable income. And so that's the first thing. But you know that there's a negative limb to Section 8.1, which says that the deduction's not available if the loss or outgoing is of a private or domestic nature. So that was the second argument in this case. And then the third one was to do with the timing, because she exchanged contracts in, I think it was June of 2020, and then settlement happened in July. And so she objected in the 2020 year, not the 2021 year. So was the loss or outgoing incurred, if it was deductible at all, in the 2020 year when it was exchanged, or the 2021 year when it was settled? And also remember, this is not capital gains tax principles here. This is ordinary income principles. So they were the three big issues in this case. So some important principles to come out of it. So first of all, just looking at the Myer and the two limbs, they said, look, we really can see that she really did have the intention of deriving a profit from acquiring this, being speculative. She was locked in. She knew she had to sell it, but she thought she could hold it for a period of time. Her whole intent was to profit from this. COVID came along, really knocked the stuffing out of a whole plan, but that was actually, the tribunal member said, I think she satisfied the Myer principle. So yes, we get up on that one. The second one was, well, is it incurred and are you knocked out because it's private or domestic? And of course, the commissioner was saying, of course it's private and domestic. She's living in it. So how can it not be? And what comes out of that is that once you've decided that there's a loss or outgoing incurred in deriving assessable income, it's almost automatic that you can't then be knocked out for it being private or domestic, because you've been already in there as it being of a commercial transaction. So it can't be private or domestic. So that all fell away, that argument from the commissioner too. So she got the deduction. And then the last one was timing. And so we know, you know, if you hold an item of trading stock and you make a sale only happens at settlement, right? And there's Gasparin's case that would hold that. And so I was thinking, what are they arguing here? But it's because there was a tax ruling 1999-7, which is all about the meaning of incurred. You know, it's sort of saying, well, something's incurred when you've, you know, capable of reasonable estimation, it's definitively committed, you've got a definite liability. And so the taxpayer, in their objection, had cited this ruling and said, well, you know, it is incurred. I exchanged. The cooling off period had passed. There was no getting out of it. I knew the amount, so I think it's incurred at that date, and I don't think we have to wait until settlement, even though we've got other tax cases like Gasparin that says that sales are only crystallised on settlement. And the principle there that's important is that if there is a commissioner ruling, public ruling, and the taxpayers relied on it, then the commissioner is bound by that. So it doesn't matter what the case law says, the commissioner's bound. So can't argue anything but, yes, it's incurred at date of exchange for this lady. So an interesting decision, because first of all, I thought, how can she get a deduction for a loss on her main residence? But she did. So we'll wait and see what happens. I think it'll probably be appealed. But yeah, some interesting principles as well to come out.
So how does principal private residence concept apply there? So she was saying she was living in it, but not as a principal private residence. That means she didn't have a principal private?
No, it was her main residence for CGT purposes.
Oh, okay.
Definitely. Yeah.
So why didn't capital gains tax apply? She probably, it was
Well,
because she always had a view of.
It was a loss. And so, but it would have been her main residence. If there was a gain, it would have been her main residence. And she wouldn't have been subject to CGT. But the Myer principle, if there was a gain, it would have been ordinary assessable income to her. Because we know how the provisions work. Because you can always have both a capital gain and an ordinary income amount. But then in the CGT provisions, there's what's called an anti-overlap provision, 118-20. And it says if you've got an amount that's taxable as a capital gain, accessible as a capital gain, and it's also accessible as ordinary income, then 118-20 says reduce the capital gain by the amount you've already included in your ordinary income. So that's kind of stops double taxation under capital gain and ordinary income provisions. But we're dealing with a loss here. So happy days. Beg your pardon? Absolutely, she did. Yeah, yeah. Interestingly, her son is a well-known tax advisor at Deloitte. I think it might have helped a bit with the objection and things. So there you go. So we'll see what happens.
There's one question on the.
Yes.
Can a beneficiary lend money to the trust after distribution of trust profit?
Can a beneficiary lend money to the trust?
After the trust profit?
Yeah, so after the trust has distributed, presumably to that beneficiary. Yes would be the answer, but I'd suggest that if you're don't want to be worried about 100A gifting or loaning, loaning would be, I'd suggest if it's at interest on commercial terms, then you'd be safe as houses.
Yeah. In terms of the timing of that loss, for example, presumably she would have made higher income in the early year in which she wanted to claim the deduction.
Yes, I'm sure so. I'm sure there's a reason that the importance of that year for the loss. Yeah, yeah. Okay, what are we up to now? Oh, Bendel, yes. So the next case, which has been appealed already, and so it's going to be a bit of a big issue. Cast your minds back to December 2009 and 16th of December 2009, where the Commissioner came out and said that where you've got a corporate beneficiary that has an unpaid present entitlement from a trust, that unpaid present entitlement we now consider is the provision of financial accommodation, which fits within the extended definition of a loan under Section 109D of Division 7A. So prior to that, the Commissioner had always taken the position that an unpaid present entitlement or a UPE, where it's owing by a trust to a company that's a beneficiary, that is not called under Division 7A. A UPE is not a loan. It's an equitable right that you have, but it's not a debt. So how can it be a loan? That was always sort of the principle and the argument. And then the Commissioner changed his position. And then in 2010, the Commissioner released a tax ruling and a PCG and basically said, look, we know we've got this sort of change now, and an unpaid present entitlement is now a loan we consider for Division 7A purposes, but we'll let you have some special provisions for UPEs with companies that are beneficiaries. And that was where you could have that sub-trust arrangement. Do you remember the option 1 and option 2? You actually had a special case where you could actually have a loan in place, interest only, for either 7 years or 10 years. And ordinarily, if there's a loan under Division 7A, you're locked into what sort of loan repayments over what time? 7 years. And it's got to be principal and interest. And that's always the push with it all. So there was that special arrangement in 2010, which actually just only ended last year. So that's been in place for a very long time. We've had this decision, and actually it was an accounting firm here that had this, I don't know if it was a test case or not, but basically it was just a simple scenario of a trust, distribution to a company that was a beneficiary, presently entitled, but the cash didn't follow. And it didn't follow for many years. There wasn't a Division 7A loan agreement. And also, he'd personally pulled money out of the trust. So the funds stayed in the trust. So they say the company was owed $1 million as a UPE. The funds stayed in the trust, but then he accessed some of that $1 million and used it. And so the Commissioner's come along, and actually pursued that it was a loan 109D, the UPE was a loan and 109D applied. Didn't actually test the other provision that could catch him of that second leg of subdivision EA applying. So, where you've got a loan or an unpaid present entitlement for a company, and then an individual pulls money out of the trust, that individual can be called under Division 7A under this subdivision EA. But the Commissioner didn't argue that, just argued with plain old vanilla, it's a loan, UPE is a loan, provision of financial accommodation, bang, you caught. So that was the position there with Bendel, and the tribunal member said, absolutely not, it's not a loan. A UPE is not a loan, and it's not the provision of financial accommodation. It's an equitable issue, and doesn't get caught under Division 7A under 109D. So it's kind of upset the apple cart for the Commissioner, very much so, because it sort of leaves us in this scenario of, remember I said there's all these special provisions, these special cases with 2010 ruling and practice statement. Where does that leave us? Because actually they'll be invalid now, because if it's not a loan, then what is it? And you've actually still got a problem that hasn't been satisfied. Maybe we can forgive it and it goes away. So the next step is it's stay tuned, but it's going to be a pretty important decision. And so it's been appealed to the federal court. So I'm sure we'll hear the outcome of that probably, if not next month, then in January. So, yeah, so we've talked a lot about Division 7A and 100A, Part 4A. So, all good stuff. But then we had a fourth case that I wanted to talk about briefly, which was this High Court decision. I'm sure you probably heard about it, but I didn't actually realise that there's a move because I guess the issue is that motor vehicles that use petrol get charged when they fill up their tank. Petrol excise tax, there's a tax on the petrol, and that's a federal impost. And so what they think the state governments thought was unfair was that electric vehicles obviously don't use petrol, they don't get the tax, and all the taxes collected for the petrol that has a tax on it all go to improving the public roads around Australia. And so the idea is well, okay, we're going to impose a state tax, and Victoria is the first one to do it. New South Wales is going to be doing it in 2027. And so I don't know how they do it actually, like realistically. I guess they're kind of tracking the car because it's on pretty much all public roads in Victoria. And so electronic vehicles pay a cents per kilometre for using a road. And that's the impost, and that's the issue. And so two electronic vehicle owners took this to court, and it went all the way to the High Court. And the issue is they're saying, well, this Zero and Low Emission Vehicle Distance-Based Charge Act that was imposed, a state tax, they say it's invalid. And that's because it's a duty of excise. And Section 90 of the Constitution provides exclusively that only the Commonwealth can impose an excise. The states can't. It's unconstitutional if they do. So the issue is whether or not the impost of this cents per kilometre for an electronic vehicle to use a public road is an excise or not. And I mean, I don't practice in this area, but I think an excise is to do with consuming something. And whereas if it's not an excise, then it would be sort of like a tax on the sale of goods or something like that, like a transaction. But this is excise is for the use of something. And they said, well, look, you are consuming something because you're using or consuming the road. And so therefore we consider it fits within the definition of an excise, and therefore it's unlawful to impose this tax on electronic vehicles. And so that will upset all of the states because they're all intending to follow suit. But the broader ramification of it is I think it puts into question some of the other taxes that the states impose. Like I think it's sort of like transfer duty on motor vehicles. And I also think on the stamp duty on the registration of motor vehicles, for example. That's a couple of them where I think it's going to be a bit of an issue.
That's a conveyancer.
Well, I think they've mentioned that that's court, because then I thought, well, then why is an all stamp duty court? Because it's a transfer. But I think it's an impost on the registration. So, you know, when you buy a car and there's a stamp duty, I think it's sort of like you're needing to get registered. So that's the consumption of something. I think that's the argument. So it will mean that I think a lot of these taxes, state imposed taxes, will have to change. And of course, all that will happen is the Commonwealth will step in and impose them and then distribute the funds to the relevant states, like they do with the GST.
Yeah, so fairly.
Yeah. That's right. There's always a bit of argy-bargy, isn't there?
We'll go to Western Australia.
Oh, yes. So B Blood versus the Commissioner of Taxation. This is a case that was a full federal court decision. And again, we're dealing with a bit of a trust arrangement. And what happened here is you had a company with profits and it was owned by a trust, a discretionary trust. And so the trust also had some ordinary income of about $300,000. And then then it also had shares in this company, and that company had a lot of retained profits in it. And what they decided to do was this whole arrangement set up by actually Clearly Hall did this whole arrangement. And I think there's going to be a whole heap of these cases that will come through on this, is that what they decided was, first of all, the company buys back its shares from the trust. So remember, the trust owns the shares in the company. Company's got lots of retained profits. Company does a share buyback and says, okay, trust, I'll buy the shares off you. And under Division 16K, when a company does a share buyback, you kind of look at the proceeds and you have to sort of look at to what extent it's a dividend and to what extent it's a return of capital effectively. And because this was massively retained profits, very little share capital, most of it was just a dividend under Division 16K. But of course, if you go to ordinary concepts, a share buyback, like a liquidation, even though the Tax Act might say liquidation proceeds are a dividend, the principle is it's still capital, isn't it? Because you're kind of ending your ownership of that asset. So ordinary concepts, it's capital. Tax concepts, it's a dividend that's assessable as ordinary income. And so next step in this whole idea that they had was then they said, okay, so company buyback now. We've got $10 million that's the dividend, but it's capital under ordinary principles. Now let's look at the trust deed, and we're going to change the definition of trust income in the trust deed. And we're going to say that trust income means ordinary concept income. And then what we do is we say, okay, trust makes a resolution and says that we've got a beneficiary, a company, a new company, is presently entitled to 100% of the trust income in this year. So if I mentioned to you we had $300,000 of other income, and then we had $10 million of a share buyback proceeds that's a dividend, $10 million so that trust has $10,300,000 coming into it. $10 million of it doesn't fit the definition of trust income. $300,000 does. Present entitlement, 100% goes to this company. So the company is entitled to $300,000, but under trust principles, the company is taxed on $10,300,000. Now, under the Bamford, the proportionate view, 100% of your share of the income of the trust estate, 100%, that's what you're taxable on, company. So it's taxable on the 10 million and the 300,000, but it only has to get cash of 300 because the capital, the 10 million, stays in the trust, even though the company's taxable on it. Franking credits, company doesn't pay tax on the 10 million, happy days, only pays tax on the 300,000. Doesn't that sound like a good arrangement? And so then that 10 million can stay in the trust as corpus, and then Joe, the individual, can reef that $10 million out tax-free because it's trust corpus. It's all been subject to tax, non-taxable. So that was the whole arrangement in the B Blood decision. And so, again, this was an argument of 100A. And this is one where 100A did apply because what was the reimbursement arrangement was the buyback proceeds. There was an arrangement for that $10 million to stay in the trust, i.e. trust reimbursed stays in the trust, even though taxable was the company doesn't get the benefit of the present entitlement and the trust retains that. And so even though it was a capital amount, it was still subject to 100A. So it was an important 100A case, all about, yes, there was a reimbursement agreement. They didn't delve into whether or not there could be a carve out for an ordinary family or commercial dealing, because they said, basically we think it's just 100A, there's no carve out available. So there wasn't a great deal of discussion about that. So that was a 100A decision. So we've had one 100A decision that I've mentioned to you, one Part 4A decision, one Division 7A decision on loans or not. We've had a bit of a interesting one on a deduction for a loss of a main residence. And then we've had the High Court decision on excise for the Victoria tax that was unconstitutional. So I think that probably gives you a bit of a grab bag of the year. I think that's all I've sort of gathered together.
Can I just clarify, the company was paying tax on a 10.3 million, is that right?
Yes. And so remember when there's share buyback, so we had companies sitting here, trust owns the company,
Yep.
and that company's got retained profits. And the company says, I'll buy back. And so what it does is it buys back the shares. So trust loses the shares,
Yep.
but the company has to pay for that buyback.
Yep.
So that company pays the 10 million up to the trust, and that's a dividend under the share buyback rules, 10 million. And there's franking credits that can go with that as well. So companies now got $10 million in franking credits. Companies also got rental income of 300,000.
Yep.
So it's sitting there and it's got, an amount of money, capital and income. It amends its deed, so to make sure that 10 million is not trust income, it's capital. And then it's got a new company it forms as a beneficiary. And it says, I'll make you presently entitled to 100% of the trust income, 300,000. So that 10 million is capital, it's not trust income. But that's sort of the way the cash has to flow. But the tax principles, remember in section 97, say that where you've got someone that's presently entitled, whatever their share of the trust income is, as in 100%, that's what their share of the taxable income of the trust is. And the taxable income of the trust was 10.3 million. And that's why the company only had to get the 300,000 distribution, but it was taxable on the 10.3. Got a franking credit, so only paid tax on the 300 effectively. 10 million can stay in the trust. Joe Blow can pull it out from the trust tax-free. Okay, oh my gosh, I'm running out for a bit over time. Sorry, I'll have to talk a bit faster. The next bit I just wanted to mention was there was a speech, Vivek Chaudhry, debt collection, that's his gig. And just as far as, I'm not sure if you're noticing it as well with your clients or the ATO activity, it's harder to get payment plans. Payment plans generally are not 2 years anymore, they're generally 1 year. You have to do a little bit of a battle about the GEIC now, where it's so long gone are where it was automatically remitted. And they're actually taking a lot more activity in collecting debts and following you up. And so the analysis that was done is they've looked, and actually small businesses disproportionately, massively, are the ones that are owing the most amount of the proportion of the debt. And the other thing that they really especially don't like is the unpaid SGC, because what they see is that's actually someone's superannuation that you're not paying. Yeah, it is like theft. And so that they pursue that aggressively. And I'm sure you're aware of that with any SGC liabilities that crop up.
I think they always did that.
Yeah, they've always been pretty aggressive with it, but rightly so. So I think that's always, and that's what I always, where clients are having trouble paying, I always, and if I say, pay your super, just pay the super, pay the PAYG, and then we can negotiate the tax debt and just get those out of the way. That's always the principle I apply anyway. For clients who have that
fact
problem.
that you paid the super and the PAYG as accommodation for the tax debt. So
Yeah, but
negotiation.
but the super account is always separate, so it's always just make sure you specifically pay that.
okay.
Yeah. And the other issue that I noticed is that they've started enlivening old tax debts where they'd written and said, we're no longer pursuing your tax debt. It might be like really, really old. They're actually now enlivening them and chasing them again. And they have every right to do so because they don't have a right, they don't have jurisdiction or the power, the tax office, to actually forgive tax debts. So, but what they do is they let you know, we're not going to pursue this tax debt anymore. So, I mean, I had a client who hadn't lodged tax returns for about 20 years and she was in an absolute mess. She got referred to me. And so she lodged all her tax returns and then the GIC and the penalties were sort of like 3 times the amount of the tax debt. And she was in an absolute mess. And what we did was, you know, sort of just said, pay the tax debt, just pay that out. And then we negotiated hard and actually got it all fully remitted, which was including the penalties, which is amazing. So I think, and if you can always demonstrate to try and pay the tax debt, then it always helps with all your other arguments as well. But it's certainly an area where it's much more active. And also we are seeing the enlivening of these old tax debts coming back to haunt us as well. Okay, next 5,000 review, just to mention that's probably an area of focus. I've had quite a few clients go through this review process. They start off as being an SAR, which is, I think it's a simplified assurance review, where it's just a bit of a light touch. They look at the group, they ask questions, they sniff through and sort of give you a chance to make a voluntary disclosure if need be. But the whole thing that they bang on about is tax governance. And what I find really difficult is when you've got a family group, sure, they might be fairly wealthy, but it's really just mum and dad and a whole heap of investments that are quite valuable. And demonstrating and answering the questions about the tax governance framework, about the controls in place and the, you know, like how do you sort of delineate the responsibilities and the activities and recording and reporting. And it is quite difficult in a SME market or in a privately owned group context to answer the tax governance framework questions. So it'll be interesting to sort of see, you know, what comes out of that. And they do say, look, we think if you've experienced growth. And so they've just released their findings and their sort of focuses, surprise, surprise, family trust elections, Division 7A. They are looking at cross-border transactions. Where it's not all properly recorded, it might not be, you know, might be with related parties and you're not properly complying with thin capitalisation, transfer pricing, those sorts of things. So it is active in this area and I think they're ramping it up and it will continue. I've actually got the process is generally there's a whole list of questions, you provide all the documentation, you have a meeting. If there's any issues that come out, then it's sort of like a matter of asserting and arguing why you took that position or not, or, you know, sort of arguing why it shouldn't be taxable if they think it is. I had one client that I've inherited that did have a big Division 7A lurking problem that we sort of argued against Division 7A being there because it was a sub-trust arrangement. But see, all the sub-trust arrangements now have fallen away. So, yeah. So that's the sort of examples of some of the issues that come up. And if I had run out of time, I was going to sort of throw out and just sort of discuss some things, some war stories, and I just thought we could just discuss some of the things that I've come across in the last year, but we've probably run out a bit of time, haven't we?
We're fine. Oh, I'm fine to stay back.
All right.
I'm not sure what the
Sure. Okay. Yeah, so here's some of the things that I've sort of grappled with in the last year, some of the few examples. First of all, I had a client who has got a company, hopefully will list next year, and he's, you know, it's been his dream for sort of 15 years probably, and he's borrowed money and he's put money into this company as loans or as capital, as and when he was trying to attract investors. So he capitalised the loans and so there was equity. And so he has, you know, significant costs of shares, so say it's $10 million. And so he was claiming interest deductions because he'd borrowed from the bank and now he's got shares in this company that is building. We're in R&D phase, got great prospects, but it's early stage really, but it's been going on for 15 years. employs a lot of people now. And so he got audited by the tax office, and the argument, and they denied the deduction for the interest on his loan. Any ideas why? Capital, yep. So there was, what they said was, well, it's never derived, you've never had any dividends or income from it. We think that there's no prospect of ever getting any profits. So we don't think it's deductible.
Let's say it's part of the cost base. Cheers.
Yeah, but that's not real good.
No.
Yeah. So yes, if it's a non-deductible, non-capital cost, then it can form part of the second or third element of the cost base, provided the asset was acquired after August 1991. Yes, so you can do that. But the whole argument was around, well, look, it's got so much losses built up, you're never going to make any money from this, you're never going to get any dividends. So we think it's got no nexus with drawing accessible income. So that was the whole problem. But of course, I threw back Steele's case at them. Remember Mrs. Steele, where she had borrowed to invest, remember that motel, and she was going to make some money from it. She was going to redevelop it, sell it off, and it never actually happened. So she never actually even got to that sort of point, and then I think she just sold it off. But the interest, remember, went all the way to the High Court, was held to be deductible right from the get-go, because there was the intention of a profit and building something of value. And so on that basis, they caved in on me, and we were allowed the deductions. So we were happy about that one. Okay, what else have I got? Oh, yes, so private company. This actually came out of one of the Next 5,000 reviews. So client that's bought all these properties in a company. And of course, like their homes and beach house, farm, and it's all in a private company. And I know, but you do lose the CGT discount, but these were all way before there was a CGT discount ever thought about. So it was back sort of like in the early 90s, late 80s. So some of them are pre-CGT actually. But and again, this is an inherited client, but so the problem there was they'd actually been filing FBT returns. And so they'd been paying rent to the company for the use of the beach house, say, if we keep it with the beach house. But it wasn't market. And so they'd sort of pay FBT on the difference. And that's what they were doing. But of course, it meant everything was deductible, wouldn't it? Because if it's sort of, if it's an asset, you're using something, if the argument is it's subject to FBT, then it's got like an employment nexus. And so everything's deductible, like, the repairs, the maintenance, everything, land tax, etc. But where it got a bit skew-if was the whole place was termite damaged. And they spent about, it's a pretty nice house, it's up on Palm Beach, and they spent about $3 million rectifying all the termite damage. And I said, I think we need to get this, come forward with this under the Next 5,000 review, because I was never comfortable that it was subject to FBT anyway. And
employment relationship.
I don't think it's in respect. They're directors and they do things for the company. They've got all other like rental properties and commercial buildings in there as well. But I actually think it's in respect to their shareholding, but it's got nothing to do with their employment. I mean, so what it means is, and I think it's the right outcome, is that it's actually now subject to Division 7A. Everything's non-deductible, including the $3 million for repairs, but we're no longer subject to FBT, is the upshot of it. And the other thing is that one of the other houses is one of the daughter's own house. So there's a couple of other houses in the company. But you know how there's a carve-out for Division 7A? Anyone aware of that? So if you've got an asset that you use that is your main residence and it's owned by a company, Division 7A doesn't apply to that. So provided the house was acquired before 2009, which is the case here. So, so we've had that battle. So that's sort of one that was picked up. What else we got there? Oh, structuring a property development using a trust or company. Have you had any clients with property developments and how do you best do it? So I think the difficulty you've always got with the trust is so first of all, a property development, high risk. So you always fresh, clean entity and get rid of it afterwards. That's always the principle. But should it be a trust or should it be a company? Now, if it's a company and you do a development, then that all works well from obviously the revenue, like you sell off, it's going to be taxable, isn't it? 30% or 25%, depending what your thresholds are. But then, of course, what often happens is they usually keep a few of the units, say, and keep them, rent them out, and then maybe later on they might sell them and it'll be a capital gain. And of course, you miss out on that in the company, don't you? So you've got this real dilemma about what to do. And then if you can do something like a unitized trust, where you might have a bit of a mix of units, where there's capital units and income units in that trust. So you can have the income units from the property development get distributed, the income goes to a company that's a beneficiary of that or unit holder of that trust. And then the capital gains, when they eventually kept those units, rented them out for a while, the capital gain can actually go to the capital unit holders. So that's usually quite a good structure. The problem with trusts and property developments is the funding. And if they want funding from within their family group, lending from a company that might have built up retained profits, Division 7A. And of course, they're never going to have the cash flow to be able to pay the principal off on a Division 7A loan. They might be able to meet the interest out of the sales, but they can't ever get to meet the principal repayments on the Division 7A loan. So I do always find unit trusts where you need some funding that's internal to be difficult, or even if you go to a bank, anything other than interest only is always a bit of a problem with funding with a trust in a property development. So I thought I'd just mention that one. So we've had some fun and games with one at the moment. Cleaning up old trusts, corpus distributions, what to do with old UPEs, where you've got no accounting, no records. Do you often find that? So you sort of got all this money going in and out everywhere and there's never been any reconciliation. So you don't really know what the unpaid distributions are, who owes what, and how do you deal with it? And of course, the dirt always comes out when you're actually getting rid of it. And I've got a scenario at the moment. I've got 4 brothers who it's an old trust and it's about to vest. And there's actually a couple of trusts and we've got, they all want to split up the significant assets in the trust. And you've got one brother's a US resident and the other 3 here in Australia. But the trust now has got UPE. So one brother is owed $10 million, another brother's owed nothing. But I am sure what's happened, there's just been some random gifting of corpus. And so we're sort of faced with this really uneven distribution where there is corpus in the trust and then there's one brother owed $10 million from the trust. And so he can get his money out, but none of the others really, we've all got to trigger everything. So it can be quite difficult when it comes up in the wash. And what we've also got the problem with is the golden rule when you've got a US resident, just don't let them get to have trust distributions because it's an absolute nightmare being taxed in the US from a trust distribution from Australia. It's sort of like up around 62% or more. So, yeah, so I thought I'd just sort of share that one with you. What else have I got? I mean, share some with me if you've got any.
I had one development on the discretionary trust. They knocked down the house and then they rebuild, become a duplex. They sell one by one. So instead it will be collection to the tax holders.
So they had a house,
and then
knocked it down,
and then rebuild with the
duplex, and it's in a trust, did you say?
The trust, the discretionary trust, family.
So, and then they're going to sell it, and the question is whether it's a capital gain or ordinary.
They can't sell at the moment. They already in the market, but they're gonna sell one by one, just one now and then probably later. Yeah.
Mm-hmm. And how long have they owned the house? Did they own the house?
The house probably about a year ago. And then we're claiming the GST on that as well.
Yeah. So all those indicators point to income, ordinary income, don't they?
Yeah,
Claiming the GST, you bought it probably with the eye on, gosh, we can knock this down.
they have a few house other, but been rented out for a long time.
Yeah.
And
I-
this one, new one, and then rented out, and then
Yeah. I mean, it's without knowing more facts. I mean, it's all very fact specific because you bought it and probably had their eye on subdividing, not
Yeah.
selling.
Mm.
I think it's ordinary income. I think you'd be hard pushed to argue a capital gain. But if you held it for a long period of time, you had tenants for a while,
Yeah.
you kind of had demonstrated that pattern. And then there was a bit of a change where you went, oh, actually, we can probably knock this down, build two, and let's sell them off that way in an enterprising way, maybe. But
they thought rent it out in the first place, but also have difficulties to have a tenant, and then that's why.
yeah, it sounds too short term for me.
Yeah.
And your intention from the get-go was to make a profit from it. So I think it's all ordinary income. Whereas if you originally had it rented out for a long period of time, derived investment income from it, and then maybe there's a change of intention, a la Whitford speech, and at least you get the first bit of it capital gain up to that market value, and then ordinary income for the rest of it.
Well,
Yeah.
thanks.
Good. Wrongly presuming a trust is a fixed trust, unit trust. And I had a bit of a nightmare with this one where this client had unit trust set up and he started up a company that now is a significant company and it gets massive dividends each year. And it's he and his other business party are the unit holders in this trust. And it gets franked dividends flowing through every year. And I kind of went, where's your family trust election? You can't do one, of course, because they're not family members, so we can't do that. And then you look at the trust deed and there's a discretion to be able to distribute under this unit trust deed. So it's actually not a fixed trust. So the franking credits in that scenario are not available. So nightmare. So you got to be really careful reading the deed with, just because it's called a unit trust doesn't mean it's a fixed trust. And if it's got dividends flowing through it where you can't make a family trust election, you really are in a world of pain. The scenario would obviously be look at the deed, fix everything, make sure it's fixed. And it's not enough that because they thought it was all right because the rights to the dividend income were fixed, they had to go there to that unit holder. But that's not a fixed trust. It might be fixing the dividend income, but that's not a fixed trust for the purpose of being able to flow through the franking credits. So yes, that was a bad one. Beg your pardon?
How do you make it fixed?
Well, you amend the deed. It fixes it going forward, of course. So you can amend the deed, and obviously you have to be careful about it not being a resettlement or anything like that. But if there's broad powers to amend, and all you just do is remove any discretion that was available there. And the other thing you've always got to check for is there an ability to issue or redeem units at anything other than market value? Because if you can do it at anything other than market value, that's not a fixed trust either. So you've got to address those key issues.
So,
trustee.
I mean, the discretionary trust can be turned into the fixed trust or unit trust?
Yeah, it can be. It just really depends if there's
Because
broad powers
I
under the
couldn't
trust.
understand the lawyer trying to, actually initially because they're being hit with the higher land tax.
Yeah.
And then because the discretionary part pay higher land tax, right? Then the lawyer tried to amend the thing
To make
and
it
then
a
make it
The land.
unit trust or fixed trust.
Yeah. What I'd worry
I
about there is
understand.
stamp duty. If it sounds like it's all to do with property in the trust,
Yeah.
I'd worry about stamp duty
Yeah.
there.
So still possible can be turned into a unit trust.
Well, it depends on the deed. I don't think you can turn it into a unit trust, perhaps, but you could fix the entitlements.
Yeah, because this is a discretionary of family, and then all of a sudden this lawyer have a idea to turn into the fixed trust. I can't follow that.
Yeah, well, it's possible. It depends if the deed has broad powers of amendment. But I would worry about that sort of arrangement if there's property in that trust that it would trigger a stamp duty nightmare for you.
Because they try to object against the
Land tax.
sort of,
Yeah, but what about?
and then they said, we can't understand this, they said, I mean, the lawyers.
I get that checked from a stamp duty perspective as well, not just the land tax issue,
Mm.
because I worry about that. Because especially I think there's been some pretty big amendments to the Stamp Duty Act in New South Wales this year as well. And it catches where there is some tweaking and changing to the beneficial interest, underlying beneficial interest in a trust.
So, I mean, when you turn into the fixed trust.
It can be a
it can
resettlement.
subject to
stamp
the
duty.
stamp duty.
Yeah, because you've changed beneficial interest.
Yeah, that's
Mm.
right.
Mm.
I agree with you.
Yeah, yeah. What's this? Oh, yes. So this was another sad story. So mum bought a house on a big block of land. So I think it was, I can't remember, square meters. Lived in the house and then became old and frail. And so what she actually did was she sold off the house with only this part of the land and she subdivided and kept the other lot there, which everyone thought was great. And so we have main residence exemption, of course. Many years ago, she did that. We've got the land now and it was sold. Is it taxable or was all part of the main residence?
Taxable.
Taxable, yeah. I mean, the daughters are horrified because they can't understand how it can be taxable because it was mum's main residence. Yes, that's right. Yes, yes.
You can't have two.
So, yeah, I mean, you can sort of have, 2 hectares surrounding, and that's what they're saying. It's under 2 hectares. I'm saying, yeah, but it has to be part of the same transaction. So yes, that was one. Oh, and just family battles breaking up the trust and Auie's case. So back to my 4 brothers again. Remember the one in the US? And I said, principal, we're trying not to distribute it to brother because it's horrendous, and we're trying to solve other ways that he can get sort of his share of the family division of assets through companies and things. But of course, Auie's case. Do you remember that decision? I think it was it West Australia or Queensland Supreme Court decision, and it was to do with a wealthy mum and dad, and there was some kids. There was a couple of wayward kids, adults, and then there was the golden boy. And dad distributed to the golden boy and neglected, like one daughter had some addiction issues. She was really sort of living rough. And then there was a son that was estranged, but also was really financially struggling. And Auie's case actually held that they didn't properly, the trustee failed in their duties, their fiduciary duties, because the whole premise of the trust and the whole trust deed is set up for the beneficiaries. And you've got to, as a trustee, your duty is to consider properly the needs of the beneficiaries, and you've got to provide for the beneficiaries when you're exercising your discretion to distribute income every year. So it is something that's just a little bit of a word of warning that can come back to bite you. And with my scenario, like of the 4 brothers, one of them is fighting with the other 3. So, just when we're doing all this divvying up and we're leaving one person out, I've just sort of asked for the lawyers to consider whether we've got, any duty to consider Auie's case. I think we're okay because everyone's wealthy, but it is something that's you do need to consider in family matters with trusts as well.
You do that by reserving complete discretion to the trustee in their distributions.
Well, that's what happened in this case, but it's just a fiduciary duty that the trustee has, and the terms of the deed. And your duty is to consider the needs of the beneficiaries when you're exercising your resolution each year.
All of them.
Yes, that's right.
If that duty wasn't in the trustee.
Oh, but it's just a trustee act, like it's just sort of like what we've got to do. Yeah, fiduciary
Obligation.
duties. Yeah, breach of fiduciary duties of the trustee. Yeah, so it's sort of it is something that's inherently there as a trustee every year, and that's why when you're sort of like you're helping your clients with trust resolutions, etc. I think always the first question is well, who needs the money this year? What's happened? Where are we landing with everything, and where do you think you'd put the money? And just have a family conversation. They need to have a family conversation, step 1, because all we ever really do consider is the tax position, don't we? But I think step 1 really needs to be have the family discussion about who needs some money.
Should you
So-
document any acknowledgement? Like a trusted,
Of a trustee.
beneficiary said, no, I don't need money this Would you,
I think if
Yeah,
you
that's right.
document, you know,
Yeah.
just sort of the way that you arrived at your resolution when you've got prickly families, I think that would be
I've had
prudent.
discussions with A, B and C.
Yeah,
you know.
yeah. And I've considered their financial position, and I think that, you know, on balance, I think this is the way that I would exercise my discretion this year to distribute. So something like that. Yeah. And I think the other thing, if you do have kids that with unpaid present entitlements, it's always good for them after they've become presently entitled, if they haven't received the trust distribution yet, it is always prudent after year end, perhaps to get them, notify them, say, look, you were made presently entitled this year to, you know, $100,000 of the trust income from the XYZ trust. Just like to let you know that it is, you know, something that you have a right and entitlement to. You can call on it at any time and get them to sign it and acknowledge it. And that's also good evidence and to sort of like push away 100A risk as well. So the Commissioner does say that. All right, I better stop. Sorry, I've gone over a bit. Good.
So thanks, Vanessa, for your time, effort, and contribution to our group tonight. I'm sure everyone would agree that it's very practical, easy to understand, a great discussions, and also very detailed. Thanks for that, Vanessa. And thank you all for coming tonight. And we hope to see you back in 2 weeks' time. And it will be our last session for this year, and it will be on our Zoom webinar. All right. Thanks very much.